It's time now for the 360 round. Let's bring in our panel to discuss earnings from Disney. Joining us now, James Czerniawski, head of emerging tech at Consumer Choice Center, and Matt Dolgin, the senior equity analyst at Morningstar. James, love to just start with your thoughts on this report.
Yeah, thank you for having me. I think that it's a mixed bag for Disney because on one end, I think that we've seen some really promising stuff. Their model of direct-to-consumer, of growing their subscriber rate with services like Disney Plus and Hulu has grown tremendously. We've seen that revenue, their profit rather, go from 99 million to over 350 million. That's really good. But on the downside, we've seen this prolonged bout that they've had with YouTube over YouTube TV and ESPN. And that, on the flip side, is not so good for the company. They don't know when it's going to end. And every single week that prolongs, the company is losing $30 million. This isn't exactly the same kind of battle that we've seen in years past between Disney and DirecTV. This is between Disney now and YouTube is in a much stronger position because it has a lot more nimbleness. It has ad tech revenue on its side, whereas Disney's a little bit more traditional in its structure, leading it to be a little top heavy. So I think when you look at those two factors, while there's a lot of promising things in this earnings report for Disney, we do need to see a little bit of a conclusion here to this battle with YouTube TV.
And Matt, what were some of your key takeaways from the report?
Yeah, I guess I'm a little bit more positive than James. I agree with much of what he said, but I'm focusing more on the parts of the business that really were good and are the most important things about driving this company into the future. And that is the direct-to-consumer, the streaming business, also experiences, which is really the most crucial thing for this company as far as its profits. But between that and streaming, those are both good, and that's what's going to drive the company for the future. I agree that the YouTube issue is problematic while it's going on, but we don't expect that to be going on indefinitely. And even if it were, as long as ESPN can essentially stay stable, and we expect the pay TV bundle to continue declining, and Disney is doing working towards transitioning to streaming with the ESPN app for streaming. And so it's not a concern that we think is going to drag down the company in the long term, one way or another. And the parts of the business that need to be performing well are performing well. So our view on the company, the outlook hasn't really changed after today.
All right. And James, you both mentioned the direct-to-consumer strategy, which is obviously very successful. I think they saw Hulu and Disney Plus tripled their profits in this quarter. Is that finally proof that the streaming model can stand on its own for Disney?
Absolutely. I mean, I think that Disney has solidified its status as one of the major players in the streaming industry, more broadly speaking. It stands right up there along with Netflix. And that's because Disney has a suite of products that's very attractive to consumers all across the world, let alone in the United States. So I think that there are definitely very positive signs of Disney's growth in this space. Having Hulu and Disney Plus both there are certainly a huge boom to its bottom line.
And Matt, you cited the same thing, but you said that you're even more optimistic about the report than James is. Then why do you think that we're seeing this significant downturn in the markets? I mean, we're down almost 9%.
Yeah, well, certainly the overall market isn't helping, but Disney was going down even before that. Overall revenue did look weak, but we think it's a mistake to just focus on that overall number without digging in. Entertainment linear networks were extremely weak, and they are just going to perpetually decline. To us, that's not something, first of all, it's built into what drives the value of this company in the long term. And second of all, not something even in the nearer term that's nearly as important. Streaming, DTC, the entertainment side, the operating income this quarter was about the same as entertainment linear networks were. In 2026, streaming will probably be much higher. So this part of the business that was so important to Disney in the past has become less and less important. And again, like James said, the direct-to-consumer strategy appears to be working. Disney appears to be setting itself up very well for the eventual pretty much complete cannibalization of entertainment linear revenue. And so with the forward-looking thought and what's going to drive the company in the future, it seems like things are fine. As far as why the market doesn't look at that, again, to us, it's a mistake and maybe focusing on too high of a level rather than what's really underneath this and the profitability associated with it for the company in total.
Yeah, and in the pull down, I keep seeing this mention of this YouTube standoff. As we look at this, James, who's got the leverage here? Is it Disney because of their content catalog, or is it Google?
Yeah, I think that they both have a lot more shared like leverage in this situation. I just think that it's Disney taking a classic approach. Like I said in the outset here, right? They've had this kind of bout in the past with DirecTV, and I think when you're looking at that kind of an example, Disney had the upper hand and leverage here. But when you're looking at YouTube, it's a completely different beast because they have that ad tech revenue, because there's also a whole host of different kinds of content options that consumers can basically go to. It's not just reliant on Disney TV. Certainly in YouTube TV, there's a lot of options that are there. So I think that it's just a little bit more balanced than what Disney is accustomed to. So it needs to adjust its strategy when trying to think through how do we bring this conflict to an end.
Yeah, it's certainly an interesting. I want to really quickly, Matt, get to our last question about the parks experiences. They're still having a bright spot for Disney. And I know that you said in your notes you've been waiting for that segment to show some weakness, and it just isn't. How do you explain that resilience?
Well, it seems like part of what we built in as far as weakness, as far as macroeconomic weakness, hasn't really showed up yet. It seems like the company isn't expecting it in 2026. So it's still built into our model. Some we'll see if it gets extended, which is what we did before in our modeling. But we think that some of the macro headwinds and potential tourism pushback in the U.S. could be in the nearer term at some point hitting the company, but long-term things still look very healthy. And like I said, to us, weakness is there. If it doesn't show up, that's just upside. If it does show up, it might be another thing that hits the stock a little bit, but presents to us even more of a buying opportunity because that business really does look strong and healthy for the long term.
Well, I want to thank you both for being with us today to discuss Disney's earnings. We really appreciate it. That's James Czerniawski and Matt Dolgin.